Today, we're diving into the One Big Beautiful Bill and what it means for your nonprofit organization. Hi, I'm Teresa Clark, and I'm a seasoned CPA with over 30 years of experience serving 501c3 nonprofits. I've experienced both as an external CPA doing audits and an internal CFO to organizations. And I'm here to serve you, so you can learn more by going to teresaclark.com. In July 2025, the federal government passed the One Big Beautiful Bill Act. This was a sweeping piece of legislation that temporarily allows individuals tax deductions for certain tip income and overtime wages from 2025 through 2028. While the headlines have focused on restaurants and hourly wage earners, there's actually some direct implications for nonprofits, especially those who might have staff that do receive tips or hourly program workers or event-based teams. Let's take a closer look at what's changed and what you're now responsible for and how you might keep compliance in your nonprofit organization. Employees in occupations that customarily and regularly receive tips as of December 31st, 2024 may now deduct up to $25,000 in tip income from their federal income taxes. This is going to be phased out for individuals that earn over $150,000 a year or $300,000 when there's a joint filing. Non-exempt employees or hourly workers can deduct the premium portion of their overtime wages. Now, let me explain. Premium portion. That's actually the extra 0.5 of the pay that's earned on 40 hours a week. This deduction is capped at $12,500 per person or $25,000 for a married couple that's filing jointly with those same income phase-outs. Note, these are federal income tax deductions for employees. They do not change your FICA payroll taxes or your state and local tax treatment. Let's talk about what this means for your nonprofit. Number one, payroll tracking just got more complicated. Nonprofits are now expected to separately report qualified tip income by occupation, the premium portion of overtime wages that have to be itemized on the W-2, and you'll need to ensure that your payroll systems can properly segment and report these figures by year end, beginning with the 2025 tax year. Number two, event staff and program workers can actually be affected. In the nonprofits I work with, the primary place that we're going to see this impact is in tipped, what I would call cafe workers. But while many nonprofits don't operate traditional tipped roles, staff working in fundraising galas, food service, hospitality, or even public-facing community events may qualify. Similarly, hourly staff such as an overnight shelter worker, a camp counselor, a program assistant, or even a seasonal support staff who receives regular overtime pay. Now, these staff members may benefit from these new deductions, but only if their wages are reported correctly. There's further guidance on this coming from our administration in America very soon, we hope. Number three, the administrative burden is going to increase. Many nonprofits operate with a lean finance or HR team, and this new law is going to add responsibilities. They're going to need to track which roles actually qualify for these deductions, and again, that's still a little forthcoming from the IRS, and we're waiting on that information. They're going to need to update their time tracking systems to isolate the premium overtime pay, and then they're going to have to figure out how to clearly report these items on the W-2s for this year, 2025 and beyond. Number four is communication with employees. It's essential. Your team is not going to understand what's happening with all this, and they're not going to know how to use these deductions unless you tell them. So consider preparing an employee briefing, or maybe your payroll processor might provide one. And you want this to explain what the new deductions are, who's going to be eligible, and how they'll find those numbers and impact them through their tax return. Now, there is some serious risks of noncompliance, and misreporting is going to result in some IRS scrutiny, and most importantly, it's going to impact your employees' taxes, so we want to get this right. Failing to update your systems is going to create headaches at tax time. And of course, incorrectly classifying those roles, especially around the tipped occupations, could expose you to some audit risk. So here's some action steps for nonprofit leaders. To prepare for the new requirements under this big, beautiful bill, you need to review your staff roles and identify any positions within your organization that are going to qualify. Now, keep in mind, some guidance on this is still forthcoming, so be watching and waiting, and I'll be here to update you as we learn more information. You need to update your payroll system. Make sure your software can track and report that tip amount separately by that person's role. You'll need to make sure that it can isolate the premium portion of your overtime wages. And again, this is only the 0.5 amount above the regular hourly pay. And then monitor the IRS guidance. Let's just all be looking. They're going to continue to be sending things out, and they've actually communicated that it's expected by October of 2025. Now, you're going to need to revise some policies and procedures. You might need to update some employee handbooks, some job descriptions. You may even need to change some of your scheduling practices in order to reflect this new requirement for overtime and tipped roles. Again, I want to remind you that educating your employees is probably the most important thing. You want to communicate with your staff so that they know about these new tax deductions and that you can be alongside of them to provide clear instructions on where they're going to find the information and how to benefit from it during their tax filing. You might even need to budget for compliance costs. You'll want to plan ahead for any additional payroll support, staffing, system upgrades, or even HR training that's going to be needed to meet these standards accurately and efficiently in your organization. I want to wrap up by making sure you also know that there are some other parts of this big, beautiful bill. Some of those include that they've expanded the above-the-line charitable deduction amount for individual donors. They've also given additional oversight tools for the IRS related to terrorist-linked nonprofits. And they've limited the executive compensation write-offs for private foundations. So staying informed now is going to help your organization avoid some surprises down the road. While the tip and overtime deductions created by this big, beautiful bill are designed to benefit individual workers, the reporting and tracking responsibility, it's falling on the nonprofit. So taking proactive steps now to understand your obligations, educate your team, and update your systems is going to save you some money, some time, and some stress during tax season. Now, again, I want to remind you the IRS is committing to provide guidance by October of 2025. Do you need help navigating these changes? Well, a fractional CFO can help your nonprofit not only stay compliant, but also implement the kind of smart financial systems that enable more strategic and forward-looking decisions without the cost of a full-time CFO. If you're interested or just curious about this, click the link in the description of this video to start that conversation. And make sure you subscribe to catch next week's video where we'll look at the major changes just announced by the IRS about nonprofits and political engagement. Or if you're watching this later, that video will be linked in the screen right here for you to click on next. I hope this has been helpful, and I look forward to serving you.